the managing director for CB Richard Ellis here in Tucson. That means I am responsible for the company's operations in southern Arizona. In addition, I support the company's debt and equity finance market in the capital markets.
Terrific. Okay, kind of start with an overview of what you see going on in the market right now.
Well, as it relates to the finance and capital markets, you know, money is the lifeblood of real estate, and it's very difficult to be a lender right now. And it has less to do with actually making loans and more to do with dealing with the loans that you have. There are massive amounts of capital on the sidelines waiting to invest in commercial real estate, and there's money available, and there's lenders who will say, we're in the market to lend, but their underwriting standards are so difficult to achieve for most properties that very few deals are being done. And while that's happening, the lenders are dealing with the stress in the marketplace caused by, you know, a weak economy, overbuilding in some markets, not all. The fact that we've had this crisis in the budget, so all those factors add up to a very difficult market to be a lender.
So with this money on the sidelines, tell me what's going to trigger some activity. What's going to get that going? We're going to start seeing some action in the market and some transactions taking place. What's going to trigger that?
It's going to be a resetting of expectations. A lot of investors who, like the fellows we've had in this morning, we've all been through a few cycles, and we're kind of expecting it to play out again. And they're seeking deep discounts, and the lenders have not been cooperating, and sellers have not been cooperating. So last year in 2009, for example, a company called Real Capital Analytics reported that of the $90 billion of real estate that was out for sale last year, 89% of it didn't get sold because sellers were here and buyers were over there. And so I think this year that gap is going to close. So that'll trigger some sales. The second thing that will happen is all the lenders, whether you're a small community bank in Tucson, Arizona, or you're a big money center bank like a B of A or Citibank, or if you're a balance sheet lender, they're all working on their balance sheet right now. And they've been reluctant to let these assets go into the market and be sold. The pressure's building. They have, I think in January there was $163 billion of commercial real estate that was in distress, some form of foreclosure, bankruptcy, or in arrears. Only $22 billion of that real estate has been resolved and moved through the pipeline, and that's growing by $5 to $8 billion a month.
Now, I've seen some reports that the distressed commercial properties are really going to be in play for maybe up to 2.5 years. It's been talked about in some of the forums around town. I mean, what's your take on that? How long is it going to take for these properties to move through the system and come back out on the other end?
I think easily 2 or 3 years. I think probably 3 to 5 to get the whole rabbit through the belly of the snake, if you will.
Yes.
You know, a lot of properties were purchased at the peak from 2006 through 8, and all of those mortgages will reset or come due in the next 5 to 7 years. So there's pressure building now, and it'll take a while to work it through. But it's a supply and demand issue. There's capital there, but the capital's not willing to commit at the values that the sellers and lenders want. So there will be a point where all that comes together and the market will clear.
In the Tucson market, which categories are under the most financial stress right now?
Well, I think multifamily is certainly feeling the stress. We have some stress in retail. It's kind of across the board. I think industrial is probably the most stable. And office is going to track along with the other markets. But generally, Tucson's not in as bad a condition as other markets around the country. Our challenge in the Tucson market, whether you're a lender, an investor, or an owner, it's really the demand side of the economy. We just don't have that many users looking for new space. You know, the businesses are struggling like we all are, trying to run our businesses profitably. And on the supply side, our vacancies are not out of whack. And so for a lender, they can underwrite the real estate as far as the physical part of it, but it's guessing what future demand is going to be is the challenge.
So I want to go a little deeper on the industrial question. Talk to me a little bit about, if there's been so many job losses, how is it that the industrial category has remained relatively stable?
Well, relatively stable is the key phrase. In the last cycle, or depression we had in the late 80s, we got up to 35% vacancy. I think now we're mid-teens. So compared to the last time it's in everyone's memory, it's a lot better off. Industrial is going to have more vacancy, like all the markets will. But again, it's less a supply problem in Tucson than it is a demand problem.
So would that category maybe recover faster than the others, or would there be another segment that would recover faster?
I think you'll begin to see it first in the multifamily market. As jobs come, you'll see immediate occupancies rise there. But in industrials, where the jobs come first, and then it's followed by retail and followed by office.